Michael Gapen is with us. He's the chief U.S. economist at Morgan Stanley. Michael, can you kind of dissect the PCE report a little bit for those of us who might have been at a kid's Christmas concert?
Well, I do appreciate the holiday references there from Steve as well. I happen to use them in our write-up. I think to dissect this one, Kelly, the big news, which we already knew from the CPI inflation data, was that housing-related inflation, or shelter, took a step lower in November. And as you know, that's been the real factor keeping inflation elevated, and it's been slowing down the pace of disinflation. We've got some stickiness in goods prices. Cars, mainly, we think that's storm-related, so there's some firmness on the good side of the ledger, but overall, a 0.1 increase in PCE, in our view, is a very favorable report. I tend to agree with Presidents Goolsbee and Williams that it's a bumpy ride, but I think there's clear signal here that inflation's moving lower. We need more confirmation of that for the Fed to cut in March, as we expect, but I think it's a favorable report in that regard.
It's the first 0.1, as this chart we're showing indicates, since May. Michael, what do you think happens in the next few months?
So we actually think December could be a repeat of this, something maybe a little closer to 0.2, but consistent with 2%-ish outcomes over time. Then, of course, we move into January, where, as you know, we get some seasonality in January. January tends to be a higher than normal month, so that one could be a little firmer. But put us down in kind of the 0.17, 0.2 in December, so continuing some of the favorable news that we've had.
Steve, the sequencing of all of this never ceases to fascinate me. What if this report had come out before the Fed's decision? You know, might Powell have had a slightly different song to sing?
I don't think so, because, and Michael can correct me if I'm wrong on this, the Street has gotten, and the Fed as well, very good at forecasting the PCE number from the CPI and the PPI. I don't remember them being quite this good, but maybe it didn't used to matter. But now it's gotten so good that even Powell will come out and tell the market what the Fed forecast is. He's done that a couple times. It's kind of interesting. I think they had an idea it was going to be relatively tame, and so that allowed them to go ahead with the rate cut. They're still forecasting rate cuts ahead. You asked me about whether or not this was the overreaction. I think Wednesday was a little bit of an overreaction, Kelly, to what the Fed did. Yeah, they stopped, and they stopped maybe a little harder than the market thought, but there's still cuts out there. And as Austin, I guess, redirected, I think is a good way to think about it. He said, look, the average Fed official still sees the neutral rate at 3%, which means you're still 100 and change over, which means you can still bring it down. I am very, what's the right word, informed by what Fed Chair Powell said when he goes, look, we're a lot less restrictive than we were, but we're still meaningfully restrictive. And I asked Austin about that. He goes, hey, that makes perfect sense to me. I agree with that.
No, I love that Austin Goolsbee, who has been saying the exact same thing for months, but it was kind of overlooked by the market. Now he's about to be a voter, Michael, and it seems to carry a lot more significance.
That's right. And I think to Steve's point, it wasn't so much the near-term inflation data, I think, that was driving the Fed's move. It was the shift from we're not going to speculate about policies to all of a sudden we are. And so that, I think, was a signal to the market that if we get some of these restrictive trade and immigration policies and inflation firms, obviously we might be on the sideline for a period of time. But I agree entirely with what Steve said, in that a hawkish Fed this week doesn't mean the Fed overall is hawkish. There's a lot of inflation tolerance, in my view, in their projections. They don't forecast hitting 2% until 2027. So if they're leaning in any direction, it's protecting the strength in the labor market. And they still do expect to remove restriction going forward. So hawkish today, potentially dovish tomorrow if activity slows, inflation comes down, and labor markets soften.